Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. The strong rebound in Chinese stocks is set to trigger a shift in global portfolios as investors rush to catch the rally. Following Beijing's latest stimulus blitz, funds that earlier left Chinese equities in favor of stocks from Japan and Southeast Asia are poised to reverse the course. This shift is already underway. Shares in South Korea, Indonesia, Malaysia, and Thailand posted net outflows last week. Meanwhile, the yen suffered its biggest drop in more than 2 years after Japan's new prime minister jolted currency markets by saying the economy isn't ready for another interest rate hike. Adding to global tensions, Israel vowed to retaliate against Iran after it fired about 200 ballistic missiles at Israel, a major escalation that world powers fear could spiral into a Middle East wide war. Good morning, JK. We have seen a bout of dollar strength lately with euro dipping below 1.11 and both the Chinese yuan and Japanese yen weakening. Despite these movements and escalating geopolitical tensions, gold remains subdued. What's your take on the markets?
Good morning, Swaraj. Yes, definitely, we have seen quite a few changes in the market last few days. Just a week ago, markets were chugging along with a bit of complacency that rates would fall by another 0.5% in November in US, followed by more cuts in further months. Yields were at more than 1 year lows, and the dollar was definitely on the ropes. But in few sessions, the market has been swamped with too many things to consider, and most of them is arguing against the comfort zone that market had tucked itself into. We have the geopolitical tensions in Middle East at the most elevated level. Most of the US data are coming stronger, and some extreme view even saying that November may see a pause. ECB is almost certain to ease with inflation falling below their target, although it is helped by base effect. Powell has changed his tone to a neutral one, with his ultra dovish tone post FOMC being slightly reversed. Oil prices have risen strongly, and the port strike in eastern coast in US starting on 1st October, both of them threatening the benign inflation continuing. Now, if you look at it, even the other central bankers, apart from Powell, have been quite vocal and influential. ECB's Kazakh said Europe had a clear case for rate cut as the economy was on a tipping point, after which investors are fully pricing a rate cut on October 7th by ECB. This has also pushed euro that had a very dismal failure above 1.12, slipped through 1.1050 support, and it looks it is headed towards 1.0935, which is a very big support. On the other side of the continent, Prime Minister in waiting, Mr. Ishiba, said Japan is not in an environment for an additional rate increase in an apparent effort to shake off his reputation as a monetary hawk. After a meeting with the Japan governor on Wednesday, pushing USD yen above 146.50, and we remember it traded at 141.60 a few days back after he was nominated as a leader of the party and prospectively becoming a PM. But that has been reversed completely after his volte-face. With these moves, actually, dollar index has been up more than 1% from the lows, having failed to even touch 100. Rate cut expectations for November is now at 0.25%, 67%, and less than 40% for a 0.5% hike. Now, two important indicators on the job markets came. JOLTS data on Tuesday that came, on the headline better than expected. But if you look at the details, the hiring rate has been at the lowest level since 2013, and the quits rate has also fallen, which means people are hesitant to leave their current jobs because the prospect of getting an alternate job is less. So that was not so encouraging. Jobless claims over the last 2 weeks have come much better than expected. We are waiting for today's number. ADP numbers were stronger, coming at 140,000, and even the previous month's number was revised upwards. We have the ISM Services number today, which we will parse for the employment component to get a better idea of where the employment situation stands. Now, any reversion to 0.5% cut expectation will require a really weak job number on Friday. Consensus now shows 140,000 NFP and 4.2% unemployment rate. These will be considered as good by markets, as markets had assumed a deep slump. A good number means a rate cut expectation of half percent should be really given up. Barring a negative surprise in Friday's market, uh, in the sense if a bad number, we see more recovery possible in dollar as other factors mentioned earlier, mainly the geopolitics helps. In just a few days, we'll have the earnings report for Q2 also being announced from companies, which will be, a factor for the risk sentiment. On the rupee side, which had underperformed its peers when the dollar was falling, has swiftly returned to near its weakest levels in offshore market, with a small rebound in even with a small rebound in DXY. And while Chinese yuan remains strong, relatively just above 7. Outflows from FIIs mattered most for the rupee after it failed to strengthen beyond 83.45, and now we are back to watching out for RBI to support, or rather prevent a break of 84, which we are confident they would. We have already seen them intervene at 83.70 and 83.80 in this move up. Now, until the global uncertainties, is rupee likely to be at 83.70 to 83.95 range again. But any severe escalation in the war could trigger pressure for new lows. Uh, on the macro side, India's current account deficit slightly widened, and the external debt also increased slightly. However, they are not much of a concern as far as the rupee is concerned, because RBI is armed with required amount of resources at 692 billion, and it's not a threat for the rupee. And current account deficit at 1.1% is completely manageable, as per the benchmark. Now, finally, just to complete the shock and wave that we are receiving in the markets, a central banker, that is the chairman of the Swiss National Bank, new chairman, hit Newswise on Tuesday, cautioning that further rate cuts cannot be ruled out. And the shocking statement was that we cannot rule out negative rates at the moment. Even we are not ruling out anything. So this was something, although market did not, react too much to it, but coming from a central banker, it is something, the most dovish statement we have heard from any central banker in the last 3 years. Have a good day. Thank you.
Thank you, Jagan. Just quickly summarizing, it seems US still has inflation risks when it comes to their macros. Port strikes from 1st October, elevated oil prices due to the geopolitics. All these are risks to higher inflation. Probabilities for a 50 basis November rate cut has dwindled. On the other side of Atlantic, European woes have continued and more rate cuts are expected from the ECB. So fall in euro and yen against the dollar has resulted in a stronger DXY. Today, of course, we have the jobless claims and ISM services data, and markets would require a strong trigger for a 50 basis cut in November. So Friday's NFP and unemployment rate will be closely looked at. For rupee, we swiftly return to the rupee's weakest level. So all eyes on RBI to protect the rupee from falling beyond 84. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.